Howdy and welcome back. It's the weekly economic update for July 12th, 2021. I hope everyone had a terrific weekend. It's been a beautiful few days here in Colorado. It's nice and sunny outside. It's not too hot, not too cool, just about perfect. So let's go ahead and dive into the news. Well, let's take a look at the news of the world and see what's going on there. There's some protests down in Cuba. Probably might have seen that on the news. I know the media and the administration has been trying to downplay this as they want COVID vaccines. I find that very hard to believe. But hey, people are welcome to believe whatever they want. We're leaving Afghanistan about 20 years too late. All those deaths over there are just a tragedy, and we really should have been there. So, all right. Haitian police arrest suspect in president's assassination. Did they get the CIA? That's who I would guess is behind it. California wildfires expand. Well, if they took better care of their forests, that'd be they wouldn't have that issue. Pfizer's discussing a third vaccine dose. I don't even have one, so I guess that's important. Texas legislature advances GOP voting bills. And evidently the leftists did a walkout, so they couldn't vote on it. So acting like adults as usual, Democrats. U.S. affirms rejection of Chinese maritime claims. Don't care. TikTok IPO delayed. Not important. Trump wins CPAC. Who cares? You know, I mean, the Republicans and the Democrats are the same. Italy defeats England. Wow, soccer. I'm sure 5 people in America care about that. So, all right, well, that's everything in the news. So let's go ahead and take a peek at the weekly economic update. Starting out here, the week on Wall Street, stocks managed some small gains as investors wrestled with concerns over economic growth prospects and a rise in COVID-19 infections. Woo, scary. The Dow Jones picked up 0.24. The S&P was up 0.4. NASDAQ added 0.43. And the international dropped 0.78. So international was a little weak. The U.S. indexes were, I'd call it flat. I mean, we talked about this on Friday. We had a bit of a, well, quite a big drop on Thursday, and then Friday everything rallied back. A lot of that had to do with some fears coming out of the administration of the government cracking down on big business. So choppy week. In a truncated week of trading, stock market action was turbulent and indecisive. A mixed start saw a cyclical stock sell-off amid concerns of slowing economic growth, while growth stocks advanced in response to falling yields. After strengthening midweek, with the release of the FOMC meeting minutes, stocks skidded when reopening fears surfaced Thursday on a new wave of global COVID-19 infections and Japan's emergency declaration to reintroduce lockdown protocols. This led to a broad-based sell-off, with financials, home builders, and technology hit hard. A drop in bond yields added to the deteriorating sentiment. Bond yields rebounded Friday, setting the stage for a strong comeback for stocks, with the 3 major indexes closing at all new all-time highs. I like how they say bond yields rebounded. What that means is people were selling off bonds. Bonds were losing value. So attention turns to bonds. Since reaching a 2020 high of 1.74 in March, the 10-year yield has been slowly and steadily declining, closing at 1.37 on Friday. One explanation may be that the reopening sentiment has turned more cautious as the Delta variant of COVID-19 spreads globally. Another view is that the overseas investors are buying treasuries, effectively lowering yields. Perhaps it's debating inflation concerns or simply excess liquidity finding its way into bonds. Whatever the message, the yield narrative has changed from just a few months ago, when it was believed that the 10-year treasury was headed towards 2%, or headed to 2%. Sorry. All right. Economic data this week. We have the CPI coming out tomorrow, jobless claims and industrial production Thursday. Friday, we have retail sales. We have some companies reporting earnings. Tuesday will be Chase, Goldman Sachs, Wells Fargo, PepsiCo. Wednesday, Bank of America, Citigroup, Delta, BlackRock. Thursday, United Health Group, Morgan Stanley, and Taiwan Semiconductor. And Friday will be Charles Schwab and Kansas City Southern. Alrighty, so we have, I'm also putting out a monthly economic update, came out this morning. So mostly the same. We've talked about a lot of this. I'm not going to, I'll cover anything that, or point out anything that's of real importance. So stocks moved higher last month. Yeah, we know. Inflation, prices increased by 5% year over year, the fastest rate in 13 years. We know that. The Fed has indicated that 2 interest rate hikes in 2023 are likely, despite signals as March 21 that the rates would remain unchanged until 2024. So the Fed is jumping back and forth in what they're doing, which leads me to believe that they have no idea what the hell is going on. So news-driven rallies, sector scorecard, what investors may be talking about in July. Earnings are coming out, obviously. We'll see whether corporate America, and investors will see whether corporate America can build upon its first quarter results. Earnings are expected to increase 61%, in part to a nearly 20% growth in sales in the first quarter. Earnings rose 52% on an 11% increase on sales. So we'll see how the earnings come out. World markets overseas were mixed in June, falling 0.33%. Indicators, let's see, the final reading of GDP for the first quarter was unchanged at 6.4%. Unemployment, non-farm payrolls increased by 559,000. The leisure and hospitality sector experienced the largest gain with 292,000 jobs. Retail sales declined 1.3% in May. Housing starts, CPI. All right. So following here, the Fed, following its June meeting, the FOMC indicated 2 interest rate hikes. We just talked about that. Okay. All right. And quarterly updates coming out also. That's a lot of words. Solid corporate earnings, U.S. economy. I'm going to skip over that. We talk about this stuff every week, so you're welcome to read it in the email that you get this week. So, all right, is financial health a factor in your overall health? I would say yes. Data released from Harris poll of more than 1,000 workers suggests that the majority of pre-retirees might answer yes to that question. 66% of those respondents to the poll identified their financial health as a component of their overall well-being. In fact, financial health ranked up near physical health, 74%, and mental health, 70%. 57% of those polled saw a relationship between all 3 factors, holding the opinion that their money, their lifestyle, and their health were integrated holistically, with each factor impacting the other. And I would agree with that. You know, if you're in good shape and you have a clear head, but you're stressed out, or well, if your income or your savings or net worth isn't quite where you like it, or if you're way behind, that can cause stress, which then can start affecting your health. And too much stress leads to anxiety and all the other problems that are involved there. So yeah, I can really see it. So being comfortable with your financial situation is, I see it as very important. It takes a lot of stress off things. Better odds of getting a job after 50. For job seekers older than 50, the hunt for satisfying work can be tough, but with such a strong demand for skilled workers this year, your own search might lead you to a job you love. In a new book titled The Job Closer, a recent subject of Next Avenue article, never heard of them, Duke University business professor and career coach Steve Dalton helps older and younger job seekers with some tips in 2021. So, all right. Well, I've always heard that older people have had trouble getting work. Now that I'm getting to be one of those older people, I work for myself, so it's not really an issue. But anyways, all right. First white paper going out this week is conducting your mid-year financial checkup. Just some things to do. Reviewing your budget, making sure you're not overspending, and if you're underspending, maybe you can divert some of that unused income to savings or something you want long term. Checking your credit score, something I check Well, I get emails monthly letting me know what my score is. Staying on top of that is important because if you go to apply for a new car, or apply for a loan for a car or for whatever, you don't want something last minute jumping up and biting you in the ass. So I do excuse me, little lemonade here. All right. And prepare for advanced tax credits. If your family is eligible, you may begin receiving advanced child tax credits in July. Families who qualify are expected to receive 6 installments via direct deposit or mail check. So that's another thing you might be receiving, even though I'm vehemently opposed to sending out money to the lazy Americans who won't pull their weight. Hey, there's a little extra money coming out there. Pros and cons of early retirement plan rollovers. To start, some basics. Let's start here at the top. Did you know that you may be able to take your 401k, 403b, or 457 and roll it to another type of retirement account while you're still working? Let's look at how those rollovers can happen. So you can take distribution from 401k plans, and most employer-sponsored plans are taxed as ordinary income. If you take one before And if you take one before age 59 and a half, a 10% federal income tax penalty commonly applies. We know that. In addition, 20% of the amount withdrawn is withheld for tax purposes. Generally, once you reach age 72, you must begin taking required distributions. Now, the fine print. You may be able to take a distribution from your employer-sponsored retirement plan while still working via an in-service, non-hardship withdrawal. This is done by arranging a direct rollover with one of these assets to an IRA. That way you don't have to pay the penalties or the taxes. and you can defer taxation. It's important to note that this option is only available if your employer allows it. Some companies do, some companies don't. I know back, probably 15 years ago, I had a list of major employers in America that offered in-service distributions because it's a good way to generate revenue, So it may be smart to speak to your financial professional. All right. So pros and cons. Yeah, as far as the pros and cons, if your company allows you to do an in-service distribution, moving that money out, the primarily the way I look at it is that you're able to invest it however you'd like, especially if you move it over into a brokerage account that's an IRA, and then you have ultimate control on how it's invested. And typically, your 401k plan will have maybe a dozen funds to pick from to build a model out of. When you're using an investment account at a major broker or an investment firm, you pretty much have anything and everything available to you, so you can build a more diversified model. So that's really the pro to it. As far as the cons, oh gosh, I remember back to my licensing stuff. Probably, I know there's some beneficiary differences. If you wanted to, say you changed jobs and you wanted to roll, that old money back into, your new plan at your new company. Typically, you can go, say you work for Ford and you get a job at Chevy. You could move your Ford 401k plan over to the Chevy. They just cut a check for whatever the total balance is. They send it over to your new 401k plan sponsor. They deposit it. So let's say you had $200,000 there. Now you're starting out your investment account or your 401k with Chevy with a $200,000 plus whatever contributions they add on top of that. So that's the advantage of that. Keeping it that way. And there's probably some more, but they're not coming to my mind off the top of my head. So. All right, oil prices hit a 6-year high. We know this. We've been talking about this quite a bit. Reached a price of $76.98. So I've been paying close attention to this. We've made some nice profits off of our oil and gas investments over the last year. When things bottomed out, it was a really good time to jump into those. So. All right, the quiet fall of bond yields. We talked about this a little bit earlier. How the Treasury closed at 1.37, down from its high of 1.74. Essentially, what's happening, why those yields are have been going down is people have been buying more bonds. Possibly moving out of stocks, moving into bonds, or the money that they've been sitting on or money that's been coming in over the last year that was excess. Maybe they've been buying bonds with those. But that's essentially what happens when you see the yield fall, is that the price is going up. So if the price is going up, typically that means that people are buying the product or buying the security. So, all right. So let's take a look at First Trust's weekly market commentary. There were a couple of snippets in here that I wanted to touch on. Bonds rallied. Yeah, we just talked about that. Hiring challenges, material shortages. I mean, we've been through this. So markets were mixed for the holiday shortened week, with growth stocks leading the way as a rise in cases from the Delta variant and declining yields led traders to favor technology stocks. Biden's executive order to limit the power of many of the largest corporations sent jitters to the market on Thursday before the S&P 500 rallied to an all-time high on Friday. Economic data points were mixed, with the ISM non-manufacturing missing the consensus forecast, but still remaining strong at 60.1. So, some good and some bad. All right. And then here's an article from Brian Westbury. He's their chief economist over there, and it's called 4,500 or Higher. And read a couple of paragraphs here, and then we'll jump on to two articles that I wanted to touch on. He starts out, many are convinced that the U.S. stock market correction or even a bear market is inevitable. I'm one of those people. So when the S&P 500 was down 1.6 last Thursday, many thought it had arrived. Then the S&P 500 rebounded and hit a new all-time high on Friday. Being bearish on equities has not worked for a long time. So I didn't think last Thursday was the day. I mean, based on my charting, we haven't crossed below the trend line. So until that happens, I'm really not going to get too torqued up over it. All right. This does not mean that the market always goes up. It doesn't mean that the government is not creating future problems. But we don't know. But we don't try to time the market. It's good advice. What is the focus is on fundamentals like profits and interest rates. And right now we believe the S&P 500 is still undervalued. I don't know about that. Last year when the S&P 500 was at 3638, we used those fundamentals to project a year-end 2021 target of 4,200 for an increase of 15.4%. However, with profits returning towards normal even faster than we had anticipated, the S&P 500 hit 4185 in mid-April, and we upped our projection to 4,500, which would be a full-year gain of about 19%. Could happen. If the steam continues to stay in the the stock market through the end of the year, I'd say anything's possible. Let's see. Let's go on. Right now, the Fed is artificially holding interest rates down across the yield curve. So when we calculate our estimate of fair value, we use a 2% 10-year yield. Using this 2.1 or this 2% rate gives us a fair value of 52.40. It would take a 10-year yield of about 2.4 for our model to show that the stock market is currently trading at fair value with no increase in profits. If rates do rise because of the economy is stronger than the Fed expects, it would likely be accompanied by an even faster profit growth. So, based upon their modeling, they expect the market to continue on the rally. I think things are going to come to a crashing halt sooner than later. All right, and this was an article I saw in my email earlier today. It says, should Congress cap Roth IRA balances? And this comes from, who wrote this? Melanie Waddle. And it starts out, a Twitter debate kicked into high gear after House Ways and Means Committee Chairman Richard Neal, Democrat from Massachusetts, said his committee is mulling legislation to limit the total amount of money that can be saved in tax-preferred retirement accounts. And Neal told Think Advisor that such a bill would put an end to the tax dodging some do when saving in IRAs, and that incentives in our tax code that help Americans save for retirement were never intended to enable a tax shelter for the ultra-wealthy. Well, boo-hoo. These scumbags, I swear, these jackasses in Congress are unhappy that they're not getting enough tax revenue off the backs of the few Americans who do pay taxes, and they want to try and screw us even more. So, an example they use is that, who was it? rule if your Roth is greater than $10 million on 12, let me just read this whole paragraph. Jeff Levine, a chief planning officer at Buckingham Wealth Partners, proposed in a tweet a very simple and fair solution to Neil's plan. Pick a dollar amount, make it high, very high, maybe $10 million to start, and adjust for inflation. And the rule would be if your Roth is greater than $10 million on 12/31, the excess becomes an RMD next year. $10 million should cover retirement expenses. I mean, this is such crap. I mean, just because, ultra wealthy people use the Roth IRA to their advantage, and probably what they're doing is converting traditional IRAs and doing a Roth conversion, paying the taxes at that moment, and then having deferred taxation or tax-free withdrawals the rest of their life. So they are paying the taxes. And here it is. They're talking about Peter Thiel, who, is he? He's a venture capitalist out in Silicon Valley. So, they're upset because, he had a huge balance in his Roth IRA, and it seemed to spark that debate. So it's just, greedy politicians trying to squeeze more, blood from a turnip. So, all right. And the last thing I wanted to share, I saw this over the weekend. Twitter mocks CNBC article for the upside of inflation is rising wages. And CNBC's article here is just hilarious. I mean, where is it? Yeah, here was the actual post on July 8th. Inflation silver lining, higher salaries. Wow. I mean, y'all, you can go and find this on Twitter or social media. It's hilarious. I mean, if inflation is 10% and your raise in your salary is, say, 5 or 10, or say 4 or 5%, you're still coming. You just lost ground. I mean, come on, people, put your heads out of your asses. I mean, whoever wrote that headline is a moron. I'd rather have deflation and have wages stay the same. I mean, then your dollar goes further. And, I mean, if you look at everything, things that the government is involved in, computers, televisions, cars, well, maybe not cars, but, the things that are pretty much left to the open market, they get cheaper with time. I mean, a computer, this laptop right here would have cost, thousands of dollars, 20 years ago. Today, you can pick them up for, a cheap laptop for a few $100s. A business one, you're going to pay a little more money for. But it's just ridiculous. I mean, look at the cost of, video games and, all technology. It's really aggravating that people don't understand economics. And I mean, it's not that hard. Crack a book. Henry Hazlitt, what was the book? Economics in One Lesson. Simple. Read through it. Anyways. All right. Well, that's everything I had for today. So I know I had a lot of material to cover and wanted to get through it. My publisher, I guess, was busy last week putting out information. So, but that's everything I have for this week. I got a lot of meetings going on, so I'm shooting this, before my next meeting here coming up at 5. So, if anybody needs anything, be sure to shoot me an email and like, subscribe, and share with friends. And hope everyone has a great week. And if I talk to you this week, hi. And if not, I'll probably talk to you soon. Bye.